Welcome to India's channel, a channel to promote India's implementation in India. With this India's implementation, it is utmost important for all the professionals and students to even understand about the accounting and auditing changes happens in India in the last few months. On 29 March 2016, Ministry of Corporate Affairs has issued a notification and has amended CARO 2015, and the CARO 2016 has come to picture. In the last CARO 2015, there were 11 clauses, and the new CARO 2016 is having 16 clauses. There are 9 clauses or sub-clauses which are being added newly or inserted newly in the new CARO 2016, and there are 4 cases or clauses which are deleted in the CARO 2016 compared to 2015. When you look at the point number 1, which talks about the applicability of the CARO 2016. When we look at it broadly, the applicability has been relaxed for private limited companies, where the criteria were earlier the same criteria, that is paid up capital plus reserve surplus. Earlier word used was loan, now it is a total borrowings, and third is a total revenue. So the criteria for identification and exemption for applicability remains same for private limited companies, but the amount has or threshold limit has been increased. In CARO 2015, the private limited company is exempt provided paid up capital and reserve surplus is not exceeding 50 lakhs rupees. Now it is increased to 1 crore rupees. Same way for total borrowing, it was 50 lakhs, now 1 crore. And for turnover, it was a 5 crore, now that is increased to 10 crores. This CARO 2016 again specifies that of which period at what point of time you to consider for the purpose of applicability and exemption. So for paid up capital and reserve surplus as on balance sheet date, that is 31st March 2016, for the borrowings at any point of time during the year, and for revenue is during the financial year as per financial statements. So total revenue, the word is used, we need to look at the schedule 3, and that will also include, in addition to the turnover which you understand, it will also include other income and any turnover, if any, which is disclosed separately from discontinued operations, which will form part of the total revenue. One important point which is to be noted here is that earlier there was an exemption even in case of the private limited companies, which is a subsidiary or holding of public company, if they fulfill the criteria of exemption. But now in this CARO 2016, it said that private limited company excluding the holding or subsidiary of public company which satisfies this threshold criteria are being exempted from CARO requirements. In CARO, it is specified that it is not applicable in respect to consolidated financial statements. So it is exempted whatever branches. Now, when we refer to section 143, subsection 8, which talks about branches and says that in case of the branch auditor also the responsibility is the same. So for branches also, one need to apply CARO 2016. Now it is CARO 2016 versus 2015. When you just make overall comparison of these both years CARO, then there are new additions which are around 9 clauses, sub-clauses are added. There are 4 clauses which are deleted, and there are few modifications in the existing clauses which are not so material, that they remain same. The purpose of this presentation is to focus you on the new additions which are brought by CARO 2016. Let us look at new additions. These are the main areas which are 9 clauses, sub-clauses which are being added. One is on fixed assets related, that is for title deeds, we'll discuss in the next slides. Loans, Section 185, 186 compliances, Managerial Remuneration, Nidhi companies, related party transactions, Preferential Allotment and private placements, non-cash transactions with directors, registration with RBI. Let us look at the first point, that is for fixed assets. Now, the clause 1, subclause C, has been added in point number 3, which says that it is now required to be reported whether the title deeds of immovable property are held in the name of the company, and if not, details thereof are required to be provided. So first thing is that what is immovable property? It is not defined under Companies Act 2013, but we need to look at the general definitions, which says that anything which is attached to the earth. So mainly it includes land and building plus fixtures or something which is attached to the earth, and which is word is a title deeds. Now title deeds generally it will include the registered sales deeds, transfer deeds, conveyance deed. Now the question which comes to mind is that what about the leasehold land and building? Now for leasehold land and building, the registered lease deed will serve the purpose of the title deed. Now let us look at this provision. It says that as an auditor, it is duty to check and provide a comment that whether the title deeds of immovable properties are held in the name of the company. So as an auditor, one need to go through, have the first list of the immovable properties. For all the list of immovable properties, we need to verify that whether the title deeds are in the name of the company or not. The requirement is to disclose and comment only in case where the auditor does not find a title deed which are in the name of the company. So in case if it is being replied as affirmative or favorable comment, that means all the title deeds are in the name of the company. Only in case where the auditor has risen or seen that the title deeds are not in the name of the company, then it has to be referred separately. One other point which is relevant is that if some conversion or amalgamation has been happened or taken place in previous periods, in that case it may be a possible chance that the title deed may not be in the converted in the name of the new company. So where the auditor's duty is to again check and verify all these title deeds. In case if the title deeds are mortgage, then the confirmation from the financial institution or bank will serve the purpose, and also you can look at the mortgage deed and any charge which is registered with the register of companies, that documents also need to be verified. One question is that what about the title deeds which are lost? If any title deed is lost, as auditor we need to ask the FIR copy which is registered, and that will serve as a purpose for the documentation. This is a reporting which is being given by guidance note which is issued by ICI, which the format can be used and it can be modified based on the each company. Next clause, or we can say sub clause, is a 3A which is added. It says that whether the terms and conditions of the grant of loan are not prejudicial to the company's interest. Now when we refer to this 3A, it is the clause 3 refers to the section 189. Now section 189 says that every company is required to maintain one or more registers which contain the particulars of all contracts or arrangements to which subsection 2 of section 184 or section 188 of the Act applies. That means clause 3 is applicable only in respect to section 189 compliance, and section 189 prescribes to maintain a register and for the transactions which are covered in the section 184 and section 188. So as an auditor we need to look at the section 184 which is disclosure for debtors' interest, and section 188 which is on related party transactions, whether the contracts arrangements which are covered in this, and for that, if the loan is being granted, then the terms and conditions, whether they are prejudicial to the interest of the company or not. So one question is that if the grant includes renewed, so grant doesn't mean only given for the first time fresh during the year, it also includes if any grant which is renewed during the year. The terms and condition word which is used in this clause is in general, so it will include also, like it will include rate of interest, terms of repayment, any conditions or covenants attached with this particular grant is also included by the terms and conditions. So as the auditor's duty is to see that whether these are in prejudicial to the interest of company or not. If it is not, we need to report a favorable. If it is prejudicial, it is duty of auditors to report the fact. Third is about compliance with section 185-186. Last time CARO 2015 doesn't talk about this section 185-186. It just talks about deposit section 73 to 76. But in CARO 2016, its duty is cast upon the auditors to verify and confirm that the company has complied with this section 185-186. Here we need to note that the penal provisions under Companies Act 2013 are very harsh, and if any auditor is found negligence, or if the auditor has willfully not disclosed something which is required, then the penal provisions are harsh. If it is done unknowingly, then 25,000 rupees is the minimum charge. It may go to 5 lakhs rupees, and if it is done knowingly, minimum is 1 lakh and it will go to 25 lakhs rupees. So these are the harsh provisions, and for knowingly there is also a provision of imprisonment which is end. So if it is knowingly done, it is proved then the penal provisions for non-compliance section 143 is the fine plus imprisonment. Now let's look at section 185-186. Section 185 says that no loan to directors and the interested parties. And section 186, which talks about the loans guarantee investments, and it also prescribes the limit beyond which if it is done, then the special approval is required. Here, one thing which you need to understand is that the audit procedure which you need to follow for section 185 is that we need to obtain the details of directors or other persons in whose directors interested. We need to check the transactions. Also, we need to see that whether the transactions, if any done, are in compliance or not compliance. And if something non-compliance is noticed, then it's duty to point out in the CARO's reporting. There are also exemptions given to the private limited company from section 185. So if the exemption has been taken by the company, then that need also be checked whether the company is eligible or not. Next point is on managerial remuneration. It says whether managerial remuneration has been paid or provided in accordance with the requisite approvals mandated by the provisions of section 187 read with schedule 5 to the Companies Act. These provisions are applicable only in case of public company. Section 197 and schedule 5, which specifies that managerial remuneration shall not be paid more than 11%, and if it is paid more than 11%, then approval is required. So as the auditor, is duty that if it's a public company for which I am doing CARO reporting, whether the provisions of section 197 and schedule 5 are compliant or not, that need to be reported. Nidhi company. Now here the clause requires that whether Nidhi company has complied with the net own fund to deposits in the ratio of 1:20 to meet out the liability, and whether the Nidhi company is maintaining 10% unencumbered term deposit as specified in Nidhi rules 2014 to meet out the liability. So if it is a Nidhi company, it is a responsibility which is cast upon the auditors to verify the rules and provisions which are required for a Nidhi company to comply with. So this is something which need to be taken to attention only in case it is a Nidhi company. Look at section 4061 of Companies Act 113, which defines Nidhi. Also look at the Nidhi rules 2014, which is notified by MCA on 31st March 14, and then the compliance by the company with respect to these Nidhi rules. Next point is on related party transactions. The new requirement says that whether all the transactions with related parties are in compliance with section 177 and 188 of Companies Act 113 were applicable, and the details have been disclosed in the financial statements, etc., are required by the applicable accounting standards. So this particular clause talks about three compliance checks. One is compliance with section 177, which is on audit committee. Two, compliance with section 188, which is of related party transactions. Section 188 says that if there is a specified list of transactions which are specified under section 188 have been entered, then the approval is required if it is not at arm's length transactions or not in ordinary course of business. So as an auditor, it is duty to check that whether the section 188 is complied or not. And third point, this clause required also to verify and confirm about compliance with AS 18. So AS 18 is on related party transactions. So AS 18, whether it's compliant or not, that also need to be confirmed here. In case of there is a deviation, it is auditor's duty to put the comment and reason thereof. Next is on preferential allotment of private placement shares. Whether the company has made any preferential allotment or private placement of shares or fully or partly convertible debentures during the year under review, and if so, as to whether the requirement section 42 of the Companies Act 13 have been complied with, and the amount raised have been used for the purposes for which funds were raised. If not, provide the details in respect of the amount involved, the nature of non-compliance. So this clause requires compliance with section 42 of Companies Act 13. Now we need to, as an auditor, we need to check that if any private placement or preferential allotment has been happened during the year, then whether it is complied with, like opening a separate bank account, receipt of the money by check or demand draft, issue of or allotment of shares in the prescribed time limits, filing of return of allotment with the ROC. So all these conditions, as an auditor, we need to verify and report in case of non-compliance. Next point 8, non-cash transactions with the directors. Whether the company has entered into any non-cash transactions with the directors or persons connected with him, and if so, whether the provisions of section 182 of the Act has been complied with. Now, section 182 prohibits the company from entering into the following types of arrangements. So basically it says that in case if it is a director or a person connected with the director, then the purchase of assets or sale of assets shall not happen with the non-cash transactions, and if it happens, then the approval is required. As an auditor, it is duty to see that whether any transaction which are specified in the section 182 are happened or not. If happened, then compliance thereof need to be verified. Next and last point which has been added, that is a registration under RBI Act 1934. It's cast upon the duty upon the auditors to see that whether the company is required to be registered under section 45A IA of the Reserve Bank of India Act 1934, and if so, whether registration has been obtained. Now this is the duty which is cast upon the auditors to verify registration requirement of the company under RBI Act 1934. So this is something which auditors need to be very sure, because any clause in the CARO has to be given comment. You cannot ignore any comment on any of the clause. So commenting on each clause of the CARO, all 16 clauses is compulsory. One. Second thing, you have to give a favorable or unfavorable or adverse or discriminative opinion. In case of any unfavorable or qualified opinion, you need to provide reason thereof, and for discriminative of opinion, you also need to provide the fact and the reason thereof. So commenting on each clause is compulsory. Now we need to report whether registration is required under section 45IA of the RBI Act or not, because RBI restricts companies from carrying on the business of NBFCs without obtaining certificate of registration, which is what section 45IA talks about. So is it a company which will qualify as a part of the NBFC definition? For that, section 45IA provides that if the financial assets of the company is 50% or more than the total asset of the company, and the financial income of the company is 50% or more than the total income of the company, if both these conditions are fulfilled, then it will be required to be getting registration under RBI. So, and thank you very much for watching this particular video.